It wasn't just Amazon that caused RadioShack's downfall. It was a combination of interest rates, comparable store sales, and inventory turnover. This is the uncomfortable truth behind RadioShack's decline. At first glance, the story seems straightforward. A once iconic electronics chain from the 1980s fell victim to online shopping. However, if that were the entire truth, then 7,000 stores wouldn't have disappeared so quickly. Many retailers faced competition from Amazon, but RadioShack had additional challenges. The company turned 3 mundane financial metrics into a weapon that ultimately pointed at itself. In this discussion, we will examine the 3 critical numbers that contributed to RadioShack's demise: interest, comps, and inventory turns, and how these factors propelled the brand into a debt spiral from which it could not escape. Stick with me, as by the end, you will recognize similar patterns in other dead retailers. In the next discussion, we will explore how these issues also affected Bed Bath & Beyond. Imagine the 1990s. If you needed a specific battery, cable, soldering iron, or part for a school project, you wouldn't turn to Amazon, you would go to RadioShack. At its peak, RadioShack boasted over 7,000 locations worldwide, more than some fast food chains. These were small stores located in convenient spots, packed with electronics and staffed by knowledgeable employees who understood circuits. The business model was straightforward: numerous stores across various neighborhoods, high-margin accessories such as cables, adapters, and parts, and repeat customers who saw it as their local tech drawer. During these years, the numbers were favorable, interest on their debt was manageable, comparable store sales were stable, not soaring, but not plummeting either, and inventory turnover indicated that products were selling well enough that they didn't sit on shelves collecting dust for extended period. The company certainly made some missteps. They drifted away from their core audience of hobbyists, pursued mass-market gadgets, and eventually became heavily reliant on selling cell phones. However, the severe damage didn't manifest until much later. According to the Digital Data Design Institute at Harvard, once growth slowed and store performance declined, RadioShack failed to shrink quickly enough. Instead, they borrowed more, which marked the beginning of the debt spiral. Leveraged buyouts are typically associated with classic private equity strategies, acquiring a company with substantial debt, loading it up, and extracting cash. RadioShack's narrative is messier. It wasn't a single, clean, leveraged buyout. Instead, it was a series of rescue financings that added costly loans as the business weakened. The result was that RadioShack, a struggling retailer, had to manage a balance sheet meant for a much healthier company. By 2014, RadioShack was carrying around $650 million in total debt, with repayment obligations stacked toward the late 2010s. When it finally filed for bankruptcy in 2015, the company was burdened with approximately $1.38 billion in debt. Here's the critical part. One of its key loans had an interest rate of around 11.5%, a double-digit interest rate in a climate where large, healthy companies were borrowing at just a few percent. Consider this as a business owner: your sales are declining, your stores are underperforming, and you've just taken on credit card-level interest rates, but on hundreds of millions of dollars. Each month, millions of cash flow out to pay interest, leaving nothing for growth, store renovations, or e-commerce development. This illustrates our first key element: interest, double-digit rates on a massive debt load. Once you reach a certain level of interest expense, your business shifts focus from serving customers to catering to lenders. The second number highlights the impact of that pressure on the actual stores. Comps collapse, sales take a nosedive. Retail success hinges on same-store sales growth, known as comps. If your comps are up by 3 to 5% each year, you can generally manage rising costs, and perhaps even debt, keeping investors satisfied. However, RadioShack's comps weren't just flat. In the fourth quarter of 2013, RadioShack reported a staggering 19% drop in same-store sales, an extreme decline for any retailer. Full-year sales were also down, and losses skyrocketed. This brings us to our second key element: comps minus 19%. You don't need a finance degree to understand the implications. Imagine you manage a shop that made $1,000 a day last year. This year, it's only making $810 a day. While your rent remains the same, your staffing costs are unchanged or even higher, and your debt payments have increased. In response, Radio Shack announced plans in 2014 to close up to 11 underperforming stores, about 1/5 of its United States locations, to cut costs and focus on stronger outlets. However, a significant hurdle arose. Some lenders, fearing they might lose collateral, blocked or restricted these closures. They insisted that the stores remain open, even if they were losing money, because those leases and fixtures backed their loans. As a result, Radio Shack found itself trapped with too many stores, falling comps, and debt contracts that made it challenging to close unprofitable locations. This illustrates how a negative comps figure is directly connected to the interest expenses. With diminished cash flow from customers and the same or rising cash obligations to lenders, we now arrive at the third number: what was happening inside the stores. Inventory rot, when shelves turn to cement. The third vital metric to consider is inventory turns. How many times a year you sell through your inventory. High inventory turns indicate that your stock is moving quickly, allowing cash to flow back in so you can reorder. Low inventory turns, on the other hand, mean your shelves are stagnant. Money is invested in stock but becomes trapped. Radio Shack struggled with declining store traffic and stiff competition from big box retailers and online sellers. They had too many stores too close to one another and relied heavily on diminishing cell phone margins. Their inventory stagnated, filled with outdated products and accessories, forcing them to mark down prices, which eroded profits. By 2014, Radio Shack was losing over $1 million daily, burdened by debts from financing holiday inventory amidst high interest rates. Despite attempts to refresh the brand, they ultimately filed for bankruptcy in 2015. For entrepreneurs and investors, key takeaways include: interest, is debt manageable? Comps, are sales improving? Inventory turns, is stock moving? Radio Shack's downfall was tied to poor financial metrics, rather than to market changes alone. Stay tuned for our next video on Bed Bath & Beyond's customer loyalty challenges. Don't forget to subscribe for more insights.